Okay, guys, been given the go-ahead. We are good to go now. Can everyone see my screen and hear me okay? Hopefully, we did a test before. That should be okay. How is everyone today? Welcome to this afternoon session. Happy Easter to those of you who do celebrate it. Today, we are going to be doing a price action strategy coaching. For those of you who have never attended before, my name is Jack. I've been trading for 7 years professionally, institutionally. Did a bit of analyst work as well right at the beginning of my career. So I've pretty much traded every asset class under the sun. However, we are going to be focusing on Forex today, although this strategy can be applied to other areas of the market. So hopefully everyone can hear me fine. If you do have any questions, feel free to please pop them into the general chat box, and I'll try and get round to it towards the end or at various points in the session. So before we begin, as always, guys, I do need to just make sure that we go through the standard disclaimer, guys. Spread bet in FX and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. The trading of these products may not be suitable for everyone, so please ensure you understand all of the risks associated with trading. The information and comments provided herein under no circumstance are to be considered an offer or solicitation to invest, and all information provided is believed accurate at the time of production. Therefore, nothing should be construed as investment advice from here on in. Information provided within this room is the personal opinion of myself, that is Jack, and not Trademo or FX Street. This content, therefore, does not constitute financial investment or tax advice. Trademo and FX Street accepts no liability for the content of or comments made during the session. So, guys, how many of you trade using price action when you trade? Or how many of you trade using things like candlesticks, oscillators, and how you view the market? Anyone at all? What about you, Ray? You said that price action is best. Absolutely, Angela trades price action. Does anyone not trade price action? Only price action, says Ray. Absolutely, Ray. I'm a predominantly price action biased trader myself. And today we're going to be going through a very simple five-filter, price action strategy that you can actually implement. It's a very, very simple strategy, and it is something that I do use every single day when I am trading. Okay, it's pretty much the main staple of how I trade. I do trade a number of different methods, but this is a bit of a discretionary strategy, and hopefully you'll be able to take something away from it, even if you don't use the strategy yourself going forward. Total rookie, says Juanita. Well, that's why we're all here. It's good to learn. We all have to start somewhere, so welcome to the session. Okay, so anyway, as I was saying, the strategy in itself. Okay, guys, very, very simple. We use price action combined with oscillators and volume. Okay, how many of you use volume when it comes to trading? Because volume, to me, is one of the very, very big drivers. You haven't got to be an expert. You can use the volume in MetaTrader to gauge where the market sentiment is. It is very, very easy to do, but it is one of the big, big tools that I find helps me to gauge market sentiment. FX Boyke, what about you? Do you use a little bit of volume? Anyone not use volume? Because it is very, very important. Okay, as well as that, guys, we use a mechanical with a discretionary bias to this strategy. It can be done 100% mechanical, but you would need to employ a specific way of taking profit, and for me, I generally don't like to do that. Okay, and we use 5 points. Okay, it can be used on multiple time frames, but just for those of you who are interested, it is limited depending on the broker that basically provides the data, DZ Bista, but you can actually use it. I've done extensive testing over the last sort of 3 years with it, and you can actually use it for this particular strategy. Okay, so as I said, you can use it on multiple time frames. Generally, guys, I take it on the 30-minute or the 5-minute or the hourly or even the daily. Okay, I generally won't use it on a 1-minute chart. 1 minute, a lot of white noise. I focus mainly on the 30-minute because I don't like to get involved on too short a term. You know, I like to do a few trades a day, but I don't like to be, too short term. And it can pretty much be traded across most asset classes. Now, you'll notice that I've said on anything that trades more than 5,000 contracts a day. That is for people who are going to be trading futures or trading anything other than FX. Okay, most contracts, most assets you trade will trade more than 5,000 contracts a day, but things, there are things that do not, things like orange juice, things like coffee at times, very, very volatile. And the reason I suggest that you use this in more liquid markets is because you don't get misrepresentation, okay, from trading. Basically, what you find is you'll get a big misrepresentation if you're trading something that has a very thin market. Okay, and this system can be used by beginners and intermediates alike. I'm going to show you the basic strategy. Hopefully you can take something away from it. We can see it on the chart here now. Very simple, guys. We use an oscillator. I favor RSI, and generally I have my RSI set to either a 14 or 20. And you can see we have the volume here. And yes, it is partially limited, but it does work very well with this system and with the various brokers that I have tested it on. The strategy itself uses 5 filters, as I said: price action, volume, support and resistance, RSI, okay, and divergence. How many of you have heard of all of those things before? Have we got anyone who's not heard of divergence or relative strength index, one of the oscillators that we can see in front of us? One of these sort of very basic oscillators you can use. You can use a bit of MACD or stochastics in conjunction with RSI for a more complicated version of this strategy. Okay, good. So everyone's heard of it. Good. So these are the 5 things that we use, guys. And it's very simple. The ones in the red are the crucial ones that we look for when we use this strategy. Okay, very important that we use these red. Okay, if we don't have anything from this red, we don't take the potential trade on. Anything in the orange, which is just slightly off that red color, you see support and resistance and RSI. They are important, but they are optional. And this color system will come into sort of effect when we start grading the trades. And again, I'll be showing you a very nice, user-friendly, simple way to actually grade the trades that you do. And then divergence. Okay, classical divergence is the one that we use, and basically divergence is very simple. Okay, what we're looking for is price to make a new high, and the RSI not to make a new high, or price to make a new low, and RSI not to make a new low. Very simple. That is divergence. We will talk about it as we get going with the strategy itself. So basically speaking, we will be popping onto a chart in a minute to actually set this up. I generally will use it on the time frame I'm trading for this potential strategy. If I employ one of my longer term strategies, or one of the strategies that employs multiple time frame analysis, I'll generally I like to use the daily. For example, you've got some absolutely huge divergence in the stocks and in that New Zealand dollar at the moment. However, fundamentally, there's no reason to be selling them. So generally, it's just on the time frame that I'm looking for, and that's why it's an optional setting. That's why it's in green. So, guys, moving on. Anyway, let's get cracking. Okay, rule 1, very simple. First thing we're looking for is price action. Okay, we're looking for a reversal. It is a contrarian system. This, you can actually use a slightly different version for continuation trading. Okay, so you can actually look for when levels break for actually a continuation of trend. But generally, this works very well, I find, in ranging markets for just taking sort of maybe 20 or 30 pips on that half hour, and it works very well at the very end of trend. But the one thing I will note with this strategy, it can be very dangerous to try and pick tops and bottoms in markets. Why do we think using a contrarian system might not be so good in a market that is maybe trending? We can see here, for example, that the euro is having a big trend up. Why might it not be an idea to use a contrarian strategy? We use a price action strategy where we get things like tweezer top, shooting stars. Any ideas, guys? Why do we think it's dangerous to go with a contrarian strategy at times? Anyone? What about you, B-Man? Anyone? Danger zone, absolutely. The problem you've got is this strategy relies on a contrarian way of trading, and that means we go against, we're looking for a reversal in the market. Now, generally in a ranging market, okay, if you get a little bit of trade sentiment and you think, market's going up here, and, you think market continues, then, using a system of things like hammers in ranging markets, combined with volume RSI and a couple of other indicators, very good for continuing the trend. Likewise, if a market is in a long-term range, there's nothing to say that you can't trade the top and trade the bottom of the range. However, if a market's in a big trend, the reason I like to use RSI and use something called the true ceiling or the true floor, it's a basic invention of mine, very easy. It's just about marking up the average over a certain period of time. It would be very dangerous, which is why we are using the RSI. So for those of you who, maybe want to test this one out on a demo account, try it out on a ranging market, or try it out when a market has been trending in a particular direction and begins to hit a consolidation pattern, and then try it out that way, guys. Don't go, don't just go picking tops because that can be very, very dangerous unless you're a very experienced trader. But again, it's up to you whether you decide to do that. Okay, so as I say, when it comes to entry, we're looking for price action. Okay, the simplest forms of price action that we can use for this strategy are things like hammers, shooting star, hanging man. Okay, and now a hanging man should only be used in a trending market as a reversal signal. Tweezer top and tweezer bottoms. These are some of the most commonly used patterns. How many of you have heard of these patterns before? John, DZ, Juanita, FX Boyke, you've all heard of these, I presume? Absolutely. They are one of the sort of simplest forms of candlestick analysis. Now, those of you who want to use a slightly more in-depth part of this strategy price action, you may take head and shoulders, double tops. You might take sort of Elliott wave into consideration. You might take things like the bat pattern and Gartley pattern, all these really complicated ones. But for this coaching, I'm just laying down the basic foundations for you guys. Okay, and so, you know, in this session, we'll be focusing on these patterns. Now, as I've said, certain discretion needs to be used when determining reversal patterns. So we can actually see in this instance here, I've highlighted one on the chart actually from sort of last week. It's actually from 6 days ago. Okay, and we can see that we have a very, very big uptrend. Okay, now the first thing we're looking for is, you know, maybe something like a shooting star. Okay, very, very important to us that we get this price action. Now, that does not indicate that we're going absolutely bullish or bearish engulfing patterns, B-man, very important. Now, this here does not indicate that we're going to enter into a trade. This would be suicide to do. And the reason it would be suicide is because we get lots of hammers, lots of shooting stars, lots of dojis. We can see lots of examples on the chart. So that is why we use a 5-filter method. Okay, so popping back to our slideshow, you can see in this instance here, it's New Zealand dollar, and it's actually from sort of 2.5, 3 days ago. You can see that price has basically moved down a little bit and then began to form a bit of a range. And we get a nice hammer pattern that actually forms. Okay, that's rule one. We need to have that price action, and we're going to be talking about grading trades later, but let's get on to step two. Step two, guys. Okay, we're looking for a horizontal support and resistance. Now, again, more complicated versions will use things like fan principle, trend lines, trend channels, you know, some of the sort of diagonal support and resistance, and as I say, things like fan principles where you have multiple trend lines. But with this particular one, we're just going to focus on horizontal support and resistance. Okay, and we can see quite clearly, you know, we've got a nice purple support and resistance here. But what does that mean? Well, guys, any support and resistance that you mark up using this strategy, and in fact, you know, you could use it in other strategies. I grade my support and resistance, and I use a green, purple and red. And the reason I use purple, I don't know why I don't use orange. I just like the color purple. So that's why I use it. So if we pop to the chart here, the idea is to try and grade the support and resistance, or see if there is a support and resistance on the chart. So we see that we get ourselves a very, very nice shooting star. And let me just zoom in so everyone can see this a little better. There we go. We get ourselves a nice shooting star. Now, as you already know, guys, a shooting star should form a higher high on the daily. This one here isn't really a shooting star because we want to see that up move and then sort of the sellers take control. Okay, and at the same time, we're looking to see if there is a support or resistance level around that sort of shooting star, that engulfing pattern, the tweezer top or tweezer pattern, whatever price action pattern you're using, head and shoulders and so on and so forth. And in this example, everyone happy that we've got a little bit of a resistance? Now, guys, we can grade these resistance levels, and that will become important when it comes to us actually trading and how much money management or how much we risk per trade. What would you say, guys, looking at this chart here, looking what we have up here, what would you say that this resistance level that we have, this sort of level here is? Would you say it's a red, meaning that it's very, very strong as a level? Would you say it's a purple, meaning it's more of an intermediate level? Or would you say that it's maybe a green level, which is sort of a very short-term level, something that may not hold up as a resistance? What do you think, guys? B-man, B-man? I would absolutely say it's a green, B-man, B-man, Juanita. I would agree. Okay, the reason I say it's a green level is need HTF to see. Okay, higher time frame to see. Absolutely, but we're just focusing on this one time frame because a 30-minute level, what you can do if you like is we can zoom out of the chart and have a little look. So zooming out of that chart, what do you think? Do you think it's a big level or a small level? What do you think? What do you think, FX Boyke? I would say it's actually probably an intermediate level. I generally will keep longer term as FX Boyke says, things like daily levels or, you know, big swing highs where we've had huge reversals as the big level where I'll look to trade and, you know, mark them up as the most important level. So for me, you know, this level is potentially a purple level, and it's important to have your levels marked up. Okay, now the grading of this level will be important to us when it comes to actually trading. So just bear that in mind. So, you know, second step, we're looking for a support and resistance level. We actually get this support and resistance level. There's one around here in the chart, and we can see we've got a rejection. So straight away, we've got two potential reasons to be entering into a trade, although we're not going to be entering into that trade at the moment. Okay. Now, just bear in mind, if price dictates there is a reversal, but there is no support or resistance level, you know, you can actually trade using this strategy, but you will need to use some of the other steps that we use. So step 3, guys, volume. Okay, this for me is potentially the most important aspect of trading. Okay, for me, volume is very, very important. The reason it's very, very important is because we are looking to trade a rejection, and we want to see that buyers or sellers, in this case buyers, in this case it's sellers, we want to see that they have actually come into the market and pushed back the opposition. Okay, think of the market as, you know, battling. Okay, you've got the buyers, you've got the sellers doing battle, and generally, you know, we can see with this particular example here, we've moved down, we've rallied back, we've moved down again, and with after a big in-sen candle, a very bullish candle with, you know, relatively low volume. Okay, it's not the highest volume of the day. That tells us potentially actually this down move's a little bit flimsy. We then look at the rejection candle that formed, and once that rejection candle formed, you can see straight away that the volume on this chart is actually higher than sort of the last few candles. In fact, you'll probably see that it's maybe even the highest that we've had on the day, which tells us that buyers have pushed those sellers back. We've opened, we've moved down off this support level, and the buyers have come in and said, no, you're not having it your own way, and pushed some of those weak shorts out of their positions, maybe taken some of the profit takers, sort of some of the people looking to take profit out of the game as well. So volume is very, very important. And generally, ideally, volume should be higher than a minimum of 2 candles, okay, before it. So we can see that with this potential candle here, we get a nice hammer pattern. We actually bounce off a little bit of a support level that we have on the chart. If we actually scroll back a couple, you can actually see this is actually a same chart, but if you go back, guys, and look before, you will see that it's actually a much bigger level than it maybe looks at the moment. We'll maybe have a look at that on the chart. So we've got the hammer, we've got the support level, and we've also got volume. Okay, and volume is probably the most important thing, guys, because if we have very little volume, okay, in the market, we are not looking to enter into the trade necessarily, or we're going to amend our risk reward. So with this particular example here, and again, let me zoom in, and this example is actually from, as I say, a few days ago, so you know it's a relatively recent one. It's one that I actually traded, so that's how I know it exists. Okay, we can see that we have our candle, we have our line, and look at that volume, guys. Over the course of this candle at 10 o'clock in the morning, we can see that actually it's the highest volume of the day by far, which indicates that the buyers and sellers have done battle, and the sellers apparently have won. Okay, so that gives us an indication that there could be a short-term bounce in the market, and that is why volume is so important, guys. Okay, now when it comes to the volume, okay, I do say that ideally we want to see volume at least as high as the prior 2 candles with this rejection, but it isn't a necessity. Okay, this is where we have to use a little bit of discretion, and we'll talk about discretion at the end of the session, because, you know, for example, if we get a very sort of nice rejection level here, we get a bit of support and resistance, and our other filters tell us that we should be maybe entering into a short trade, but volume, is maybe on par with this particular amount of volume, or maybe on par with this volume. That doesn't mean that we can't take the trade, but it does mean that we do have to amend our money management. FX buy key, I do include engulfing patterns in this particular strategy. It is any price action where you see a reversal. I've focused on just the 5 most common ones for you today, but engulfing patterns, I use them all of the time. There was actually a good example of an engulfing pattern, and I believe it may have been in the Euro CAD at some point this week. So very, very much a case that we do use other price action. It's not a case that I've just marked. I've just marked some examples up for you, FX buy key. Okay, it's not a case of these are the only ones we use. I use things like head and shoulders. I'll use inverted head and shoulders, as say Elliott wave, lots and lots of other ways of doing this. But again, play with the strategy, find out what suits you. The engulfing pattern, a really, really good pattern in my opinion. Okay, so Ray Huss says importance, not all brokers include volume on their charts. In that case, what I would suggest, Ray, is you look at, you can use things like market news, but that will cost you money. In order to find real-time volume, just download a demo account from a broker. You haven't actually got to register with a broker to be able to download things like MetaTrader, TradeStation, all these other things. You can actually just have that there, but volume for me is crucial. It's very, very important when it comes to trading. I use a charting software called CQG that incorporates a very, very good volume tool, and for me it's massively important. So you can download a demo account and do it that way. Right, guys, anyway, cracking on, okay, with the session. Okay, volume is important. For me, it's probably the most important thing on the chart at confirming a potential reversal. So very, very important. And again, I do use a little bit of discretion there. Okay, the 4th and 5th steps will pretty much involve your RSI. Now, again, the more complex and intermediate versions of this strategy actually do not rely solely on RSI. Okay, a more advanced version of this strategy actually relies on using 2 oscillators. You're using either stochastic RSI, you can use MACD and RSI, but for the simple strategy, guys, and we'll look to build on this in future sessions, I've used RSI just to highlight the point that it's very, very easy to see things like divergence and when a market is overbought and oversold. And I use something in RSI called the average ceiling and floor, and it's just a very, very simple trading related tip for you guys for when you're actually using an oscillator, in this case RSI, during a trending market, because you will notice that the RSI that we use will depend on whether or not we are ranging or trending. If you're in a ranging market, we use the 30 and the 70 level, and if we are in a trending market, we're going to use this average ceiling and floor, which I'm going to show you how to just plop onto the chart in a second. Again, very, very simplistic way of doing this. I can see that John Cardenas says Forex does not have real information of volume, you only have the volume of your platform. Yes, but in extensive testing with this, John, I found that it is very, very good. You've got to remember that a potential broker that you use, for example, say that we were using a large broker, FX Pro, they get their liquidity from a certain liquidity provider and it goes to a bridge. Okay, now this liquidity provider will be, it goes to basically someone who will then push it onto the liquidity provider. Okay, and what happens there is you have a series of banks. Generally, that liquidity is reflective of other liquidity that is in the market. So, you haven't got to worry too much that you might think this is not wholly accurate. You are right that it's not, a true representation of total market liquidity, but I use this all of the time, and I can assure you that it's reflective. Just like, your quotes are different. If I have a different broker to you, my quotes are going to be slightly different with things like the New Zealand dollar. And this is another reason why you should maybe consider liquid markets for this particular strategy. Okay, because liquid markets, regardless of broker, will move in the same way. Okay, you're not going to get big arbitrage opportunities between the sort of big, more liquid products, because otherwise everyone would just be spreading one broker against another broker, and you'd have pandemonium in the markets. It's not within the individual broker. If you are a straight through processor, for example, if you're an ECM, an ECM broker will create a marketplace for you where traders will see each other's volume and things like Trading Technologies, the platform uses an ECN. It's connected directly to CME Exchange. But if you're an STP or you're someone that basically pushes you straight through to a liquidity provider, you're not going to just see, trades from your broker because, that liquidity provider isn't exclusive to your broker. Okay, that liquidity is like a big ball of money that people just, lots and lots of millions of traders, lots and lots of different brokers around the world, might be hooked up to. If, for example, I don't know, big liquidity provider, Credit Suisse, Barclays, they don't just exclusively say our FX Pro or IG, we're going to let you use our liquidity pool. It's not done that way. Price action, yes, we are using price action, but price action determines primarily why we trade. The reason we use the indicators, because indicators are confirmation tools, FX Boy Key. Okay, this potential strategy, again, you can tweak and take the RSI, but there is a reason I use this RSI, and you can see why when it comes to grading trades. So anyway, guys, we're just going to crack on now. We'll come back to these questions at the end. It appears that we've started a bit of a debate on volume, which is quite good. So anyway, guys, RSI, we use the 30 and 70 level during certain market conditions, and we use the average ceiling and average floor during a trending market, guys. Okay, so very, very important that we remember this. And then step 5 is RSI divergence. Now, this is an optional filter used for us for trading, and divergence is very, very simple. If we look at a chart and we actually pop onto the New Zealand dollar, let's just mark this up here so we don't lose our spot. You can see in the New Zealand dollar that let's find an area where we have some pretty big divergence. There you go, some divergence here. You can see between this area and this area, price is making a higher high. Okay, but you also see the RSI between the same area. As price moves higher, it's actually moving lower. It's actually not breaking this 76 level that we have here, this peak. And what that tells us is that potentially the market can be tired. However, if we have a little look at the S&P and we have a little look at the divergence that has occurred there, just because you get divergence in a market does not mean that that market is going to reverse. We've got some divergence pretty much as early as 2010, but yet 3-4 years later, we still are heavily diverged. We can see that price continues to move higher. That RSI continues to fail to break the prior high that we've seen there. And that tells us a market could potentially reverse, but it doesn't guarantee that a market is going to reverse, as we can see in this stock example. And that is why we're using this potential strategy, guys. We basically use it as an optional filter. Okay, it's something that we can use. Now, we're going to talk about the average ceiling in a second, actually, Drew, when we get on to the next slide. Okay, so moving on swiftly to the next slide. Okay, basically, when it comes to finding the average ceiling and your entry level, okay, in fact, we'll do the RSI. We'll do that in a second, I think, guys. We'll do that once we get to the point of entering into a trade. So when it comes to entering a trade, guys, very, very simple. Okay, once you get your 4 or 5 signals, you're looking to very simply enter on the open of the next trade. An aggressive trader will actually enter into a trade once price reverses up past the prior low of this example here. So when we open and we reverse back up, they would enter. But generally speaking, guys, when it comes to entering, and we'll pop back to the chart for this, what we're actually looking for is when we get the signal, when we get our 4 or 5 signals, and you can actually trade this with as little as 2 or 3, and that will be shown in a second when we get onto the money management, you actually enter into on the open of the next candle, and that is this potential candle here. So you would actually enter into your trade. Okay, very, very simplistic. Okay, the reason we use the open and we don't enter on any other point is because we need to confirm that our reversal signal has stayed in place. The price action, okay, dictates that we have got an actual reversal along with that volume. Okay, as well as that, guys, we also need a stop loss. So if we just mark this up in orange at the moment, and then we mark up another level stop loss, guys. Again, a little bit of discretion can be used, but generally speaking, your stop loss will go above the high of the price action, just like when you're trading it in a very simple strategy guide. Okay, you'll generally pop it above. Now, for me, with the 30-minute chart, I generally will place it a minimum of 5 pips above the high, because quite often what you'll find is when you get a reversal candle, you will get this candle, and then the next candle you might actually pop back through the high as all the people that have got short begin to get stopped out, and we're seeing very, very short-term stops occur, and then you see the market come back. So generally a few pips on a 30-minute above the high can be your stop loss. Obviously, if you're on a shorter time frame, you may decide to put it slightly lower. Now, if there is a support or resistance nearby, it's very important that basically your stop loss either goes above the high of the price action that you see, the reversal signal, or above the high of the support and resistance. So let's pretend our resistance level was here. You know, if we actually dictated that this was a potential for an entry for us, and you'll see how we grade it in a second, you wouldn't put your stop loss here, you pop it above the resistance level. Okay, so that's your entry and that's your stop loss, guys. Very, very simple. Now, when it comes to actually finding your profit target, you need to use a little bit of discretion. And for me, there are various methods that I use using the very simple version of this strategy. Okay, use of support and resistance levels, very, very good for us for finding profit targets. For example, if we have a little look at our euro trade here that we could potentially have taken, and let's just pop it out the way. We don't want to be influenced by any other levels. You know, we can see we've entered the trade here and our stop loss is a little bit above the high. Okay, in terms of profit targets, you know, you want to be marking up your support and resistance levels, and it's very, very important that you grade them. So, you know, your red levels are going to be those levels that you see maybe on a daily chart, those levels that have been seen as big rejection areas. Okay, your intermediate are going to be like your 30-minute levels. Okay, levels that, you know, potentially price will have a bounce off, and then you have your green, which are very short-term levels. And generally, you know, when it comes to taking profit, how I like to do this is very simple. Let's pretend that this level here is a green level on the chart. Okay, when it comes to taking profit, I will take more profit at levels where we have a purple. Okay, generally I will look to take, you know, 50% of my total position off around the level. You can see this is about 30 pips away. Okay, and then, you know, I'd hold some of the trade, and when we get down to a shorter term level, a green level that is sort of less strong, it's had less sort of rejections maybe, I'll look to take around 25% off, and when we get to a red level, generally speaking, I'll look to take at least 75% of the trade off. So, you know, using support and resistance is another way to actually put your profit target in. Other way that I like to use is I like to give the market a chance to carry on running. Okay, so I will use price action again, because if you get a rejection and then you get another rejection and that coincides with maybe a support or resistance level, that's going to give you a signal. Look at this, guys. We get a sell signal, it comes down. Okay, we then get that buy signal. So in the market here, if we were to move along and again move this red line out of the way, we can see that market moves nicely, and then we get a pretty, you know, big rejection signal here, potentially on a support level. I would probably have looked to take some profit here, not very much, but I would have looked to take some. Okay, when we come down to this sort of area, we can see we have a purple level. We reject that purple level again. I look to take a bit more of profit off the table. And even though, you know, you think that's not a big move, that's a 30 pip move, that's a 15 pip move. And, you know, if you held any of the trade after, you can see that the euro actually continues moving down. One of the other ways that I will use profit taking is, again, if we begin to enter into a trend like we can see in this euro, you can see that we have a big up move, we reverse, we break our support and begin to trend down. I will use the RSI as a potential. And again, when we hit a trending market, I will use the average ceiling and floor, which we're going to talk about in a second, how we actually trade that. So how many of you have heard of the ceiling and floor before? Any of you? Anyone at all? Okay. Basically, I'll be surprised if any of you have heard of it, because it's a little nickname I've given, just a little thing that I do, a little tip that I do. Now, finding the ceiling or floor, very important, guys. Okay. When we're trending in a ranging market, our ceiling and our floor is going to be 70. Okay. And we're going to use that for entering into a trade. Okay. When we're in a trending market, however, okay, price will not bounce off that 70 level. So you need what is known as the average ceiling or average floor. And to get the average ceiling or floor, it's very, very simple. You need to take pretty much things down a level. And we are looking at, we are at this point here. So we will look further back. Let's delete these levels that we've got. Okay, you need to take this sort of high point, okay, where price will generally reject. Now, it's not the highest point because you can see in this example, we actually get up to 92, but it is sort of the area where on the majority of occasions, price will actually reject. Now, in my own sort of trading, generally over the past month is fine, but I do actually look to see, you know, if we can do it longer term. Okay, I do like to do it on a longer term bias. And if we look at the average ceiling now, very, very simple, guys. We've very rarely peaked through this 84 area. Okay, so for me, 85 is the level that I have. And then on the downside, I can tell you already, guys, it's around 15 to 20. Actually, if you see it where we generally bounce from, it's around that 17 level. Going back, you can see that price will quite often have bounce. Now, it doesn't mean that price isn't going to diverge. Okay, but it is an average level that we will use. And when it comes to entering your trade, you can actually use this because if you get a very nice area on the chart where the RSI after a big down move, for example, we get a bullish engulfing pattern here. Okay, at this point, okay, you can see that the RSI is around that 1920 level. And that basically, when used in conjunction with the fact we have a potential support level, we have price action telling us to move higher. And as well as that, you know, we get pretty decent volume. It's not as high as the prior two candles, but it's up there with the day's high volume, you know. That tells us that basically, you know, we're going to get a rejection potentially. And, you know, this RSI confirms, you know, we have to move out of here. And the fact is, generally, you know, we can move out of here if price moves down. But what you will find is, generally speaking, if you have a reversal pattern, have good volume, your RSI is overbought, and you have a rejection of a level, that will generally indicate you're going to get at least some form of bounce in the market. OBOS, overbought, oversold. Absolutely, FX Boyke. I presume that's what you're talking about. Yeah, pretty much. It's the true ceiling and true floor of the RSI, and it's in the trending markets that you have to use it. I generally, minimum of the last 20 trading days though is what you have to use it for, guys. Okay, that's what we have to use it for. Okay, in a ranging market, important we use the 70 level and the 30 level because price will generally bounce off there. So popping back to the slideshow. Okay, we now move on to money management. And the reason that this strategy is called a 5-point filter system is because we're not looking for all 5 points to actually trade before we put a position on. In fact, what we do is we use a filter system to decide how much we actually trade. A very simple filter system. Very, very easy, guys. We use a minimum of 2 signals from 1 to 3. So either price action, volume, and support and resistance have to come to play. And when that happens, we risk a very specific amount. And again, I'm doing this based on my own principles. If you risk slightly more or slightly less on a trade, you can amend it how you see fit. Okay. Now, the more signals that are confirmed, the greater risk we take per trade, and we risk no more than 2%. Okay. That's standard money management practice. So let's have a little look at how we actually do this. Very easy, guys. If we go onto a chart and let's just have a play, shall we? And we get a, there you go, we get a bit of a hammer here, okay, at the bottom of a move. And we actually have something, a rejection and a rejection. That's actually quite a bullish signal there, okay. If we just see a hammer, okay, and then we look at price action, we look at support and resistance, there's no level around there. We look at volume and the volume's, you know, really, really poor. Say the volume was down here and the RSI sort of in the middle of the range. Then we don't take the trade, guys, okay, because there's only one reason for doing this. And your risk to reward, because you use a trailing method, FX Boyke, generally the risk to reward I found is around 2.34 to 1 in my trading. It depends when you get out of the trade though. You know, I've had trades that have gone, you know, 200-300 ticks on a daily. It depends on the time frame, but generally you need a minimum of 2 to 1 risk to reward. Okay, so if you are going to use support and resistance for your profit target, you need to make sure that you're only taking trades where there is a minimum of that 2 to 1 ratio. So popping back to the slideshow, if you have price action and volume, but there is no support and resistance level, generally I will risk 0.5% of my trading account. Okay, as I say, no more than 2%. So let's find New Zealand, shall we, and have a little look in the New Zealand dollar or even in the Aussie dollar. Okay, so here we have a good example. we see that we are in a little bit of a up move after a bit of a range. So in this example, we see we have a bit of a resistance zone, we have a shooting star, okay? That's two of the things that we can use to trade with, okay? So price action and support and resistance we can use, but we wouldn't use it without volume, okay? So if you have like a reversal candle and volume to support a rejection, you can risk up to 0.5% of your account, guys, or that's what I do with this strategy. You can do obviously what you like. And then basically, if we have price action, volume, and support and resistance, it is as follows. If you have a short-term green level, you're risking 0.5%, okay? No more than 0.5%. Maybe you would risk even less with just price action volume. If you have a purple level, i.e. an intermediate level, you know, a good 30-minute level that's rejected a few times and being good support resistance, 0.75%. And if you're using a daily level or, you know, a big level, a red level, you risk 1% of your account as long as you have price action, volume, and support and resistance. Okay, then if you have price action, volume, support and resistance, and the RSI is either in a trending market at the true ceiling or in a ranging market at that 70 or 30 level, okay, you can risk 1.5% of your account. And then if you find that you have price action, volume, support and resistance, RSI, and divergence, that's it, the magic 2%. That is the 5 filter system at its best, and it's a high conviction trade. So if we actually look at an example on the chart, we can see with this particular example in the Aussie, okay, we have got a very nice shooting star that has appeared at the top of the market. We now look to see what sort of level we have, and bear in mind that we probably should have already checked this level. For me, you know, that is something we have marked up already. I would have that as a purple level because it's an interesting high that we've touched a few times, not necessarily a red level in that Aussie, okay? And at the same point in that chart, okay, we can see that our RSI is in the middle of the chart, okay? So if we actually look at this potential example that we have, and I do need to find the example again. There we go, it is here, okay? At this point, we have at least 3 filters, okay? We have support resistance, shooting star, okay? And the RSI is above pretty much that 85 level, which I find is the true ceiling on a lot of currency pairs, okay? So that's 3 reasons to get into a trade. Now what we need to do is we also need to look at volume, and we can see what's the volume like. Oh, volume on that candle, it's not higher than the prior 2 candles. So when it comes to risking that trade, everything else has pretty much set up except for divergence and the volume. So if we come back to our chart and we have a little look, we can see that we actually trade price action. We've got a nice purple support and resistance. We have also got our RSI above that 85 level. Okay, so the maximum you would risk is 1.5%. Okay, the volume though is a little bit off, and this is where discretion comes in, guys. You know, the volume is still pretty good on that candle, and we still have, you know, three other reasons to enter the trade. So for me, instead of risking the max of 1.5, because it's a purple level, I would probably risk around 1%, 1.25% on that trade. And the reason I would do that is because, as I say, volume, which I use as a big gauge, although it's pretty decent on this candle, we can see that, you know, it is higher than the 3rd candle that we have here. It is lower than our day's high. It's lower than a significantly higher candle. So, you know, I'm a little bit less enthused. I'm not too keen. And obviously, guys, you know, we haven't really got divergence indicating a potential market reversal, which generally comes about in a trending market. So which time frames do you get different color support and resistance? Well, for me, this is simple. 5-minute levels are green, 30-minute levels are purple, and daily levels are red. But again, it's entirely up to you, FX Boyke, how you do that. But generally, that's how I do it. 5 are the very short term, purple with a 30-minute, and a sort of 30-minute, 1 hour. Daily levels are the red level. Would you take the trade if you have a PA and purple level, but volume is not so good? I would, as long as the price action was at, you know, a good support level. And for that instance, you know, if volume's not so good, and if we didn't have the RSI as well supporting, you know, a ceiling or a floor, I would probably, you know, instead of risking, you know, maybe let's pop back to the slideshow. You know, instead of maybe risking, you know, let me go back, 0.75%, because we don't have the volume and because we don't have the RSI, you know, it's probably, you know, less than 0.5% on the trade. You know, so you can mix this up a little bit, guys, but generally as a rule, these are the increments that we look for. Okay, so guys, as I say, discretion, very, very important. You know, in terms of what we have here, I use 30-minute predominantly, but you can use up to 5-minute and daily chart as well. I will show you what a hammer looks like in a second, Juanita. Right, guys, so discretion, very, very important. Okay, this is the point we're talking about here. If we don't have all 5 fielders, it doesn't mean we can't trade, or just because we only have 3 fielders, doesn't mean we can't trade if they're not perfect. Okay, because let's have a little look at this euro dollar again. Similar trade that we showed earlier. Okay, we have this shooting star and we have pretty good volume. Okay, but the RSI is actually below that 70 level from this range that we're in. Okay, so you know that tells us potentially we could still move higher. So basically speaking, you know, you wouldn't necessarily take that trade with sort of the maximum risk that you could, you know, that 1% or that 1.25% that you could take. So instead, you know, think to yourself, well, it still looks pretty good. We still have an RSI near that 70. We still have a very good level. We still have price action and we still have volume. So, you know, for me, I still want to take that trade, but I would risk slightly less. So I'd maybe risk 0.75%. Likewise, in this potential trade, we see that we get a nice hammer form. It is at a support resistance level. But again, the RSI lets us down a little bit. And actually, if we look at the volume is substantially higher. So for me, again, you know, technically speaking, we've got 3 reasons to be in the trade, but the RSI isn't at that 30 level, but it is close to that 30 level. So, you know, for me, instead of following the strategy 100% and just saying, okay, in this case, we're only going to be risking 0.7, I'll still happily maybe risk 1% because, you know, that RSI has struggled to tick down. We've got a very good rejection there. It is, you know, in a range in market, so we're not always going to hit the ceiling or the floor. So, you know, don't be afraid to just use a little bit of discretion there. Yeah, average ceiling's done over a month or longer. Generally, 20 days is the minimum because you want to see how prices move. 30 minutes, Driv. Now, Juanita, for you, a hammer pattern is this little pattern here or this little pattern here. Can you see that? Generally, you want this to occur at the bottom of the market. Okay, it basically is a big, long, thin tail underneath a little blue or little red body, or green and red, whatever you use. Okay, and it looks like a hammer. Likewise, this one here looks like a hammer. Average ceiling is in trending markets. I will make this available for anyone who is interested. Anyone who wants to take the slide deck away, we can actually do that. Guys, we are nearly out of time, so we're going to have to forgo our little trading competition, unfortunately, which is a little bit of a shame. What I am going to do, though, is I am going to randomly pick one of you for a trading related prize, and I will message you at the end of the session, so stay around at the end of the session rather than do the competition. Next time I am on, I promise I will make time for that competition, and it will be a survival of the fittest. But I will do a raffle in a minute. So I'm going to go through the remaining participants that we have in the room. And I am going to pretty much just randomly pick someone at the end of the session. So, you know, as soon as I close the session, I'm going to message one of you and one of you will win one of 3 things based on a random generation. You will have either a personal coaching with myself, a strategy evaluation, or a series of trade evaluations, in which point we work on your strategy, we work on things that you do, and trying to help you sort of along as a trader. And we'll be doing that on Tradimo itself. So make sure you hang around, guys. So, end of the session. Do we have any questions? Anything at all from you guys? Good luck to you all indeed. Did I say this? Oh, John. Oh, John. Been very, very quiet, John, and then you just pop up with that compliment. Absolutely great. Now everyone wants to say thank you. Ah, funny that. Okay, so any questions from you guys? Because if there isn't, I will obviously I'll officially end the session, and then within 30 seconds, I will message the winner and obviously give you details. I am using tech analysis. Price action, is the basic premise of this strategy. You are looking for those reversal patterns and things like support and resistance. If you're talking about price action using level 2 data, so you're looking, at orders, order flow, things like that, that's a sort of a bit of probably a more complex take. For example, do you trade ECN using price action itself? Because all of this is price action. The candlestick analysis is analysis of price action. It tells you price action is pretty much the, what the price has done over a period of time. Obviously, we do bring oscillators in and we do bring volume in, and we don't necessarily look at order flow. But, these are support tools for this potential strategy, and it helps us with reliability. If we have a look, if we traded every single price action reversal pattern that we traded, head and shoulders at the top of the market, we'd have lost money. If we traded everything that we see with price action on its own, you have to be able to filter it. And as an intermediate or a beginner trader, it's not always easy for everyone to do that. So using indicators is a good way for a lot of traders to do that. I myself am happy to just trade price action all day long, looking at what the flow's doing, but unfortunately you can't do that. So Ray, I hope that answers your question. Right, guys, pretty much going to call that the end of the session. Which broker is the chart showing? Fortunately, I'm not allowed to advertise one broker over another, guys. So brokers, I use a number of brokers, anywhere ranging from Census Capital to IG Markets. Ceiling and floor of the RSI, again, use it on the time frame you're trading. So for me, the ceiling and floor is going to be on that 30-minute time frame. The reason I use 30 minutes, I really like the 30-minute time frame. I get lots of signals, but I don't get too many signals. I don't get covered in grey noise. Out of all these filters, volume, absolute volume for my part, Umar, as a support mechanism. I mean, you can't trade without the price action reversal. You can't trade without the support and resistance. But the volume is what confirms. This tells you what a market has done. This tells you underneath whether there's any real momentum there. There's no point in having a big move if volume's really low. That tells us that just one person bullying the market, there's a lack of liquidity. Generally, economic data and news, there is a slight rule. If you are trading around news and fundamentals, simple rule is you don't trade this strategy around news events. You have to wait a minimum of sort of 30 minutes to let the news filter in. But it depends on how big the news is. I trade news all of the time. I generally trade a different system. Generally, yes, K-Chan, I would avoid news on this strategy. The reason is, guys, let's have a quick look before we go at the dollar CAD yesterday. Okay, news trading, big big comments from Pollot, pretty dovish. Okay, if we had used this strategy on a 5-minute over news, you can see that we get a shooting star here, price moves up. And if something's fundamentally moving, a fundamental will smash a technical every day of the week. It's bigger. A technical is smaller than a fundamental. Right, guys, I'm going to have to wrap the session there. I think we are over the allotted time. So hang around, guys. I am messaging the winner of that prize. I will tell you what the prize is, and make sure you come to the next coaching, guys, because there are prizes up for grabs in every single session. And so, it would be good to see you guys. For those of you who are interested, that is my email address. You can email me at any time if you would like the slide deck. And basically, I will send it across to you. Before we go, as always, guys, this session has been brought in to you in conjunction with FX Trade and Trademo, trading education site. Lots and lots of things on there, guys. We've got a nice hell of a community there. Lots and lots of cool guys, beginner traders, advanced traders, intermediate traders. We offer a whole load of free content, guys, for you there. Most of this is unrestricted, so you can learn about things like social trading, tech analysis, even learn some strategies. And we do have the live trading classroom with over 25 hours of sessions a week with the likes of myself, the likes of Andrew Jekin, live trading, lots and lots of other things. To do this, you can just sign up and you get most for free, guys, simply by trading. But those of you who are in America and can't sign up with a broker, obviously, you can obviously go through the subscription model, and you can see we get lots and lots of different benefits, lots and lots of courses, lots of lessons, and lots of services such as VIP channels and personal tutoring. And you can actually do that very simply by just trading with one of obviously our partner brokers. So guys, that has been the session. Winner of the prize, just hang around at the end. I have messaged you now, and make sure that you message me on that email to the winner. Unfortunately, I didn't post my email, so let me just pop this now. There's my email there, guys. Whoever's won, congratulations. And if you just send me an email, we'll talk about your prize and go through arranging how we can do that for you. Again, guys, if you want that slide deck, just send me a message. Right, guys, I am going to shoot now. So thank you ever so much for joining. Bit of an erratic finish today. Must be the amount of coffee I've drunk. I hope you've had a lovely afternoon. I hope the trading's going well, and I wish you all the best over this Easter period, guys. See you later. Bye-bye.